What's going on, team? This is Carlos, CEO of GAR Capital. I'm going to do a quick YouTube video. I've been getting a lot of feedback on the Instagram lives. Not very good quality. I would think that you guys don't want to see my face. You really want to see what's on the board, right? So we're going to talk a little bit today about something that a lot of people don't talk about, is bonds. Oh, bonds are fun. Not really. So what is a bond? Let's talk about bonds real quick. What is a bond? Bond is your lending money. You're lending money to a company, a state, city, or the federal government. You're lending money to them, and then you're going to get paid back for a fixed period. So, what does that mean exactly? Okay, so let's give this example that I guess the one bond that everyone kind of understands is the 10-year bond, which is the U.S. Treasury bond. So how it works is that you lend the government X amount of money for 10 years, and they pay you a fixed return. That's what we call bonds, so you know, fixed income. Now keep in mind, guys, when it comes to bonds, that is the largest financial instrument on planet Earth. Not stocks, not Forex. Well, Forex is big, but again, when it comes to volume of trading, bonds is the largest. That's the one that everyone talks about. Yes, Forex is big, but it's not very big in the US. Obviously, Forex is the most liquid, but bonds is the key. That's the one everyone looks at. So again, 10-year bond, US Treasury. Keep in mind, if we'll get to that in a second, but again, what is a bond? You're lending money. If you're buying a bond, you're lending money, 10 years, as an example, to the US government for a fixed percent. So again, right now bonds are right now about 2.67%. So why is this important? Why are bonds important? Why do we give a crap about bonds? Well, everything is based on the 10-year note. Again, your mortgage, your credit cards, everything. The Fed always bases on the 10-year bond because this is what they have to pay to lend money. Now remember, it's not just you letting the government borrow money if you want to buy bonds. Again, you've probably heard of savings bonds, which your grandma gives you when you're like 10 years old and you hold it till like you're 18, 20 years old and you make like 20 bucks on something small. Well, remember, this is traded billions and billions of times over daily. So imagine that. How many bonds are traded on a daily basis? It's called fixed income. So we're going to kind of get into a couple of things. First thing we're going to talk about is government bonds. Government bonds is probably the easiest to understand. So we're going to stick with the 10-year as a good way to predict stock market movements. Everyone says, why do you care about bonds, Carlos? I think I'm one of the only traders that gives a crap about bonds, but this is the reason why. Okay, 10 years, 10-year bonds. First thing we got to understand here for 10-year bonds or any kind of bonds, yield, which is the percent, and price is what you pay. They move inverse of each other, meaning opposite. Move inverse, opposite. So again, if yields are up, what does price do? Price goes down. If price goes up, what is yields going to do? Yields go down. Simple as that. They never move together. 10 years, 2 years, 5 years, they usually move in sync, but again, it all depends on demand. So, today, 10-year bonds were down 1% yield-wise. If we were down 1% relative to the last trading session yesterday, we're down 1% on the yields. What happens to that? What does the price do? The price went up. So if price goes up, remember, we know supply and demand, we trade stocks, we know Forex. Supply drops, demand goes up, what happens? Price up. And just the inverse. Supply up, demand slips, price goes down. And remember, what do we say when price goes down? Yields go up. And then this scenario, yields down. Now, why do yields go up and down? Remember, 10-year bonds or even government bonds are not the only game in town. Again, there's so many other bonds. Give me an example. Tesla has bonds, Microsoft has bonds, Apple has bonds. They'll take your money, they want to borrow cheaply, depending on their credit rating. So we're gonna go over that credit rating here in a bit. But if you watch The Big Short, that sort of thing, everyone kind of talks about The Big Short and credit default swaps. That's really complicated. But again, what they traded in that is bonds. They didn't trade stocks, they traded bonds. So just a heads up. But again, supply drops, demand goes up, price goes up because we have less supply, and the demand is up, yields go down. And just inverse, supply is up, demand slips, price goes down, yields go up. Right? So why does this happen? If you're the only game in town and no one's buying bonds, the US government bonds have to increase the yields to bring in demand. They have to compete, just like anything else. This is the free market. You gotta compete somehow. So again, when you have 10-year bonds at 3% as an example, 10-year, 3%, that means everyone is selling bonds. That means no one's buying bonds, and then we need to increase the yield to bring in more demand. And then again, just inverse. If yields are falling, we don't have to worry about bond price. Bond prices are going up, everyone wants it, yields are going down. So now we know about bonds. So what I want you to do, this is you could do on TradingView. You could do this. US 10-year, US 10Y is the US 10-year yield. You can literally compare this to the SPX, S&P 500, and you'll see something called an actual convergence or an actual movement together where the yield moves with the SPX. We have something called a correlation, a positive correlation when they move together. When you have a negative correlation, what does that mean? They move opposite of each other. Or you can call it decoupling, you can call it negative divergence. But again, just for English purposes, we can say correlation. So again, the word you want to keep in mind is correlation. So what you should do every morning before you're trading stocks, you need to see what the 10 years are doing. Now, how do I find the 10 year? Again, you can go to TradingView, put this ticker in, US 10Y, or you can go to Bloomberg.com or CNBC and see exactly where the bond yields are at. If bond yields are up, more times than not, SPX will be up. If bond yields are down, same thing, SPX is down. Give you an example. Come over here. S&P right now is down, where are we? ES is down 13 handles, which is S&P 500. Let's go and put SPX here. Oops, SPX. SPX at 2777, right? Excellent. So we're gonna go to Google, which I have it on the left side. We're gonna go to TradingView. Can you see, Nick? Mm-hmm. Excellent. I'm gonna go and sit down. I'll let you guys watch behind me. All right, TradingView. We're gonna go to TradingView, just like I explained. Very simple. And we're gonna put in US 10-year government bonds, right? Again, this is free, guys. You don't have to pay for anything. This is free. We're just giving out free information. I just put follow for some reason, sorry. Don't worry about it. You don't have to sign up for an account if you don't want it. I mean, it's free, go for it. Okay, we're launching the chart now. So right now, this is Apple. Oops, let's see if I can lower this. Here we go. You know what? Your screen is a little large here, Nick. There you go. Lowered it a little bit. Okay, so we're gonna type in, what do we type in? US 10-year, right? US 10-year bond yield. We're gonna go on an hourly chart. And you could see here that the US 10-year yield is down. Now we're tapping 26950. 2.7 was kind of the line in the sand. We were nearing 2677. According to their technical analysis, they want to buy bonds, meaning short the yield, right? So let's go ahead and compare it. You can actually literally compare it, which we can show the S&P. And you could see here, based on this movement, I'm gonna go ahead and bring up a daily chart. What do we see here? Now we have a decoupling of the S&P or a negative correlation to the upside. But you've seen that we basically had a positive correlation on the S&P with bonds. Look at the 10-year here. We decoupled here since January. But if you would have followed the 10-year, you would have been here at the low and followed here at December all the way down. Even bonds led the rise up but then S&P continued the rise. Well, again, this is just a leading indicator. Where bonds go, remember, if bond yields are falling, bonds are going up. So again, you can see that continuation. Now, bonds are kind of ranging here on a daily. We're seeing continuation to the downside. Let's go and bring up an hourly chart. I'm gonna go and kind of, here we go. And you can see the continuation to the downside, and you can see this bounce here. Now keep in mind, SPX, we have a flat trajectory here due to the closing of the market, but yet government bonds do trade overnight with Asia and Europe. But you can see this nice little pivot here. We could bounce here, but again, we still have a lot more to go for bonds. Again, if bonds can continue the upside, it'll definitely push up SPX, which is the S&P 500. Again, it's a good leading indicator of what we want to see. Again, we'll bring up the daily, and you can see the correlation. Upside, continuous here on the actual basing here, and then a downside move with a spike right in December. Bonds kind of slid off, and then we had a negative divergence or a decoupling of bonds and S&P. This continues to show upside, yet we're basing here on the 10-year. So again, if hedge funds are buying bonds, that takes away money from the S&P or from equity buyers. So again, if you're seeing this kind of movement, kind of a basing, they're not exactly selling bonds. Right now, they're buying bonds. Again, if yields are going down, that means they are buying bonds. If yields are going up, they're selling bonds. Selling bonds are bullish for the market. Just a heads up. So again, that helps us give us a leading indicator of where the market is taking us. So according to bonds, when CNBC or any of these people talk about smart money is bonds. Fixed income traders, fixed income investors are the ones that think ahead. So again, that was just federal. That's federal bonds, government bonds. Again, federal is AAA rated. Or we can equal that to, for layman's terms, 850 FICO. You've heard of a FICO score, right? Your credit score? Again, they go as low as 350 to 850. 850 being the highest, meaning the government prints out the freaking money. Now, you have different states. You have New York, you have Chicago for cities and stuff like that. Different kind of communities, they have their own bonds. For schools, this is how money gets transferred. Again, they want to lend at X amount. Where's the market at? Now again, you have Fitch, S&P, Standard & Poor's. It's Fitch, Standard & Poor's, and Moody's. These are your three bond rating. Now, if you really want more information on the bond rating and how it affected 2008, I really suggest you guys to rent the movie Inside Job. It's a great movie. Check it out. And they talk a lot about Fitch, Standard & Poor's, and Moody's, and exactly how they rate bonds. Now, there's different ratings, classifications, but we're gonna go by A, triple A's, double A's, A's, B's, double B's, triple B's, and lower. So pretend this is your highest credit score, 850. Now I'm pretty sure you have all seen The Big Short. If you're into finance, you understand the Jenga thing, where he was talking about, 850, triple A's get paid the highest. They're the lowest risk, lowest payout, highest risk, highest payout. This is like lending your uncle was a 500 credit score, $500, so he can pay his rent. You're probably not gonna get your money back. Highest risk, highest reward, right? Yeah, that uncle that gambles. So highest risk, highest reward, triple B's. So again, gets paid out the highest, but it's the highest risk. Lowest risk, lowest return. You know, if you're older, if you're a mutual fund manager, more likely you're gonna be doing the triple A's. What companies have triple A's? Federal Reserve, the government bonds at 10 years, 5 years, 2-year notes, whatever. And then also two main companies have AAA ratings. That's J&J and Microsoft. So again, if you bought J&J and Microsoft bonds, more likely you're gonna get paid back because they have great credit. It's like they have an 850 credit score. They don't need the money, more likely. I always say credit scores are a base of a factor. Do you really need it? And more likely you don't. So again, these are the credit ratings. Now, why are we talking about this? This is what we call corporate bonds. So again, I'm gonna give one example of a low rated bond, right around B. Good old Tesla. Don't we love Tesla, Nick? Mm-hmm. Good old Tesla. I don't have access to the bond market right now. I'd have to look it up. But Tesla, if you look at the bond price on Tesla, you can go to TD Ameritrade. There's no chart, but they'll give you the actual sheet of where's the yield and how much you're paying out. Now again, they have different kinds of maturities. 5, 10-year, 30-year, if you really want to go far. How much do you believe in Elon Musk, right? So again, you can literally lend Tesla money instead of owning stock, and you'll get 6%, 8% return. on your money. But again, this is not guaranteed, this bond. If you buy this and they go bankrupt, you're taking a bath, you take a hit. That's it, that's all it is. If you buy stocks, the stock price can go down, you can take a hit, but most likely goes to zero. Okay, bad example in Tesla. Don't answer that question. It's not gonna go to zero. You never know. But then, again, that's how bonds are rated. Now again, we talked about how the S&P is led by the bond market, right? So again, I'm gonna go ahead and just wrap this up. I want you to look at the 10-year, always, US 10Y on TradingView. Now, there's one thing that people always talk about, the yield curve. I've talked about that many times. What does that mean, yield curve? What is that yield curve? Okay, you're a bank. Banks borrow at a 2-year note. They borrow at 2-year note prices. That's their interest rate. They lend at a 10-year. The difference between the 2-year and the 10-year is what we call the spread, or the yield spread. Now, if you buy something for 10 years versus buying for short term, what do you expect to get more of a return on? The 10-year, right? Obviously. But sometimes demand goes up for the 2-year. Shorter term notes. What would cause a 2-year note to gain high demand? The Fed. If the Fed decides they're going to raise rates, why would I want to buy a 10-year note when my interest rate is going to be lower? I'm better off hedging by buying a 2-year and getting a higher return. Since the Fed is going to raise rates, that increases demand for bonds, right? Exactly, they pay higher. So the yield curve will, what we call, flatten. That's something that the banks do not like. So if the yield curve flattens, you want to look at XLF, BAC, JPM, Citi, Wells Fargo. Why? Because they're big lenders. Goldman Sachs, not so much, they're not a retail bank. Morgan Stanley, not so much, they're an investment bank. But the retail guys, the regional banks, RF, SunTrust, whatever, regions, they borrow at a 2-year, they lend at a 10-year. If it flattens, or the spread, the yield spread, the yield curve flattens, meaning the 2s, let's say for example the 2s and 10s, and you see this kind of movement, and they come together right at this point, and they actually converge or flatten, that's not good. Because then you're gonna have something called a lockup of lending. And lending is the lifeblood of our society. Everything's credit in the United States, everything's credit. Lending for homes, to build homes, to give letters of credit for construction companies, for small businesses. Mm-hmm. So again, very important. Now, if you didn't know this, how would you know if the market fell? You'd be like, why are financials falling? More times than not, it could be yield curve or it could be bonds. Again, you want higher yields. Higher yields is a good thing because it's a bull market, usually, unless we have runaway inflation, which is not good. We don't have that. We have very low inflation. Bull market, and also lending profits. The spreads are higher. So I want you to do this at home. This may be a little outdated depending on when you'll see this video. We're in March 2019. 3%. If the 10-year hits 3%, I want you to take a look at financials. Because I guarantee you, well I say guarantee you, but more likely they're gonna be up. And that's bonds for you. Those are bonds. So again, a lot we went over today, but the 10-year is one thing I want you to look at. 10-year breaks 3%, we're not there yet, we're 267. Breaks, I want you to take a look at financials. Very, very key. Again, this will give you the leading indicator of the market. Take a look right now. We're on a daily chart. Take a look here, Nick. We're gonna bring up a 15-minute chart because we're bored. Let me see if I can bring this up. And you could see a nice little pop right here. See the divergence, the convergence? Now we're coming back. 2694, 27, we should get a nice little pop in the S&P for today. We'll get a nice recovery, but again, usually the 10-year and government bonds, fixed income leads the way. So again, that's kind of a crash course on bonds. Hope this helps, but again, this is where the smart money is. If you know where bonds are going, and you know why they're going there, it's definitely gonna help you in your trading career. Thanks so much, guys. This is Carlos, CEO of GR Capital. Have a great rest of your day. We'll get you more information as we go. More great stuff to come. Thanks.